So hello everyone, welcome to the IOD. My name is Yvonne Deville. I'm the chair of the Finance and FinTech Group in the Institute of Directors. And today we're going to have a very interesting panel discussion about the cryptocurrency exchange, FTX, and the collapse of the cryptocurrency markets. Before we start with the webinar and the questions, I'd like to just say a few things about the Institute of Directors. Institute of Directors has been founded in 1903, and in 1906 it achieved the Royal Charter, which means it is one organization where you can become the chartered director. Last year we had over 20,000 members, and currently on the LinkedIn page we have over 70,000 followers. And the IOD Finance and FinTech Group main mission is to bring finance and fintech closer to everyone, and we would like to be we'd like to be seen as the center of excellence for finance and fintech subject matter experts. And so we welcome everyone to follow us and join us and participate in our events. Right, and today we will start with about an hour of questions and answers from our panelists. You will be also able to have questions. We will allow about 25 minutes in the end of the session for the questions. If we cannot answer all questions, we still invite all of you to put those questions in the chat, and then we will answer those questions in an email. So if your question is not answered, don't worry, we will make sure that you will receive the answer. And just to be aware that this session is recorded, so you will be able to listen to it again in about a day or two when we'll share the recording. Okay, lovely. So let me then introduce to you our panelist. So as I said, my name is Yvonne Deville. I'm going to be the moderator today on this call. And then our speakers are Jeff Hancock, who is the co-founder and CEO of CoinPass. We have Anatoly Karachilov, the CEO and founding partner of Nickel Digital Asset Management. We have Thorsten Dewing, the head of ETC platform. We have Guy Davis, the blockchain specialist and cybersecurity specialist. And we also have Philip Serocci, the head of business development and Genius Yield. Right. So FTX, I think the three letters is something that no one will forget. In the last few days, we've had quite a lot of news about the collapse of this company, and on 11th of November they have filed for bankruptcy. And what happened is that caused a chain of events and almost collapse of the cryptocurrency. So the question is, what actually happened? What really happened with FTX? Philip, can you start?
Yeah, hi, hello. So yeah, basically FTX and Alameda misused customers' funds illegally for years. They were doing all of that for their own benefit. And they were using their own FTT token to get large loans from centralized lenders like BlockFi or Celsius. We saw what happened with them also. And they were shorting those tokens on the market. So the thing is that FTT tokens had very low circulating supply and the price of those tokens was high. So the fully diluted market cap was also even higher. And then Sam Bankman started quietly lobbying against DeFi and forced customers to use FTX. CoinDesk published the Alameda's balance sheet, suggesting that Alameda was insolvent by having $8 billion of loans backed by FTT. And the thing is, unlike bank, a crypto exchange isn't authorized to simply lend your assets unless it's outlined in their terms of service, which is not. It's actually quite opposite. So it's legally a theft. And then CZ saw all of that, announced dumping. And I was always wondering, the question was why Caroline, CEO of Alameda, tweeted that they would like to buy those tokens OTC over the counter of $22 when the price was lot, it was below that, and why won't let CZ to dump all of the tokens to bring price down so FTX could buy it even cheaper? Well, it is because of the token went down, margin calls. If the token went down, margin calls will occur, and all the collaterals in FTT would be liquidated. So they started selling Solana to raise some funds to buy Niscat. They didn't manage to do it. Tether froze some accounts. Withdrawals will halted, and at the end, Chapter 11 was signed. And Sam actually had some kind of interview with Vox over text, and he confessed of stealing funds. He's blaming the other founders, like messy accountment and coding a backdoor and of not caring about ethics at all. And he still thinks that he can raise 8 billion by lobbying media to show him as a good guy. So yeah.
Guy, what do you think? What's your viewpoint?
Well, thanks for that, Philip. From the way I've been looking at it, it seems insane what's going on. Someone tweeted yesterday that the FTX story has gotten so insane, I don't even try explaining it to anyone because they wouldn't believe me. And when you really dive into it, you see it starts to bring in, well, let's just say the bankruptcy hearing has said that there's huge amounts of assets have either been stolen or they're missing. The new CEO, John Ray III, who actually overlooked the Enron bankruptcy, said he'd never seen such a complete failure of corporate controls and complete absence of trustworthy financial information. And so what this looks like is internally, there was no corporate due diligence. Lawyers believe that no financial statements were ever audited. There were no professional, third-party professionals or affiliates who looked at FTX's books objectively. And therefore, when CZ announced he was going to offload a large number of FTT and investors panicked, FTX had no corporate controls to meet the demand of the withdrawals, and the thing just collapsed with that, like a house of cards. And on top of that, obviously, there's other companies leveraged against this. There's Gemini, as you mentioned, and Grayscale and a few others that they're all kind of involved in this. So it looks like a contagion that's going to spread. But what's even more worrying is when you look into, and I was actually thinking of making a tin hat because it makes me sound like a conspiracy theorist, but there's actually there's actually official notes of meetings with the SEC on regular dates from March right up until the 11th, and at no point were any of the auditors, regulators, government agencies brought in to actually look into what was going on. And then I can go into tin hat area and go, well, he was a very large donor to various parties. Why hasn't he been arrested? What is going on? This is really not good at all, and has set the industry back just years. So that's my take on it from a sort of regulatory compliance point of view.
Yeah. Torsten, what is your point of view on that? What do you see there?
Let's try to get a little bit away from this crypto element, because I think a lot of people try to understand what is happening in crypto and think FTX is happening in crypto. But really what's happening here is some, as Philip said, some big fraud case, right? So there's one entity which is set up and creates some sort of like token, i.e. shares. It issues something, like tokens are not shares, but just for simplicity. And that issues that to the market and people give it money. And typically you give money to those kind of like subscription events like shares or bonds, etc., because you trust them or you have done some due diligence, right? And then they get the money, they give them that paper, and then that money goes to another affiliated company and affiliated both in terms of shareholding, but also in terms of the other CEO, which turns out to be romantically affiliated as well with Sam Bankman-Fried. And while that is nothing to be frowned upon, is some certain conflict of interest which need to be disclosed in sort of kind of when you're raising money from other people. So that money goes in there into this trading unit called Alameda Research, and Alameda Research goes and punts in the market and like lends it out and like takes quite significant risk, as a trading unit may be totally fine to do, but it normally does it on their own funds, not on some random funds it gets from an exchange, which actually costs them money, right? And so that corporate structure is interesting, but what's more interesting is like you can do this as well in traditional finance, right? And it has happened in traditional finance, Enron all too well, right? And a whole accounting firm has collapsed on that. What's different here in FTX is like there were so many red flags which people apparently willing have not adhered to. Like the accountants on FTX were like two small accountants which have completely no experience in frankly doing accounts on a complex structure like FTX. And if you look at the corporate structure of FTX, it looks much more like a big conglomerate rather than a small little exchange and a small little trading unit. It is actually quite complicated. So again, there's a lot of corporate governance which hasn't been adhered to, but there's also a corporate structuring which has happened in the background to masquerade what actually is going on. So ultimately, somebody put a lot of brain effort into what can we make look like a very simple structure, so people give us money and then we lend it to the market. If prices go up, happy days, right? Everybody's happy. But as we know, prices not always go up. Lehman learned that and led to the collapse, but Lehman wasn't for that. Lehman was just over-levered. This is a combination of over-levered and Enron. So I think I called it one point the Frankenstein of those two moments, right? And this can happen somewhere else. It's happened in crypto. It's bad for the market, bad for adoption. But it certainly could have had happened somewhere else as well, right?
Yeah. Anatoly, what is your take on that?
Well, I think that here we are confronting, because we started this conversation as failure of crypto or collapse in crypto. Realistically, this is not a technology failure. Instead, there is a rather massive lack of ethical behavior, lack of internal controls, lack of check and balances, and dare I say, lack of intelligent business behavior. And fundamental weakness of the whole FTX story was this cozy relationship between FTX as an exchange and their sister, well, at some stage was a main business, Alameda Research, which is a hedge fund founded by SBF a few years ago. So what happened that the whole story evolved around building an exchange and using Alameda as a market maker, but essentially without segregating properly these two entities from each other, and each of them was tapping into others' resources, right? So fundamentally, they couldn't resist tapping into customer deposits, cookie jar of the exchange, and using it for the proprietary operations on the Alameda level. And fundamentally, the whole system became a victim of this vicious circle. If you think Alameda originally was an arbitrage firm, right, which was dealing with arbitrage opportunities across multiple exchanges, even before FTX came to existence. But then they realized there are limited capacity operations. There is a restricted yield in pure arbitrage operations. And they thought that actually getting leverage and going degen long is by far more viable business. And that's exactly what they did. As market evolved and institutional size leverage became available through people like BlockFi, Genesis, and others, Alameda just levered themselves. Again, how they get access to this funding? Well, it was mentioned that FTT token, which is a native FTX token, was built in a way when the large part of this token was kept by Alameda, whilst much smaller part of these tokens was released to the market. As market was trading these tokens, and essentially, I think Alameda itself helped, pump value of these tokens. When a small part trades at a very high valuation, that creates market reference for the rest of your token pools. Now you have suddenly a massive collateral, potential collateral, which you can go to other providers of liquidity, pledge this collateral, which is artificial high price, borrow whatever asset you need, and then kind of deploy this in other activities. Unfortunately, for the market, they went beyond pure liquid operations, but went into VC-style operations, right? Having invested in multiple companies, and everything this was illiquid, which means not only you are using client deposits, which you are not supposed to touch, you're also kind of infringing the term structure, i.e. you take liquid stuff and putting it into illiquid type of operations. And it becomes only a matter of time until you are squeezed on liquidity. And what we saw over the last couple of weeks was exactly pretty much mathematically guaranteed outcome.
Yeah. Thank you. Jeff, what do you think?
Yeah, I mean, just echoing some of the other points we've heard there. I mean, this is less about crypto and more about, corporate levels of mismanagement, misappropriation of funds, and handling of client money. But a lot of these things probably could have easily been avoided. Let's put greed aside just for the moment. But from a people perspective, a lot of these people had huge conflicts of interest. They were old dorm mates, room buddies, living nearby in vicinity of these people that landed very high positions of power, obviously very well paying as well. Not to mention some people worked in the same position at both companies. So imagine a head of risk working for a hedge fund. It's not really a good idea if that head of risk to also be at FTX, let alone their only 2 years of experience in risk management at, let's put Credit Suisse aside for a sec. You can put that to as many memes as you like, but there was a huge failing on the corporate governance side for the people that were making these decisions. And I'm not saying regulation is the answer to everything, but when we got our FCA license for our exchange here in the UK, they looked very seriously and deep at who are the people behind the tech, who's the people that are guarding the front lines from an AML and KYC perspective. They don't care what software we use. They don't care how strict our security policies are on touchy of cold storage, hot storage, whatever it is. Who are the people behind the scenes driving that business? And when we're a small firm of 15, 20 people, and some of us had multiple hats, that was something that had to be rectified within a period of time. After overcoming that, we're good and ready to go. But some of those key aspects of just the people behind the business was a real big set of red flags. I mean, I'm not sure the total size of the corporation behind FTX and Alameda, but I've heard there was either a tiny accountancy team or no accountancy team whatsoever, and it was relied upon external, accounting firms to try and, just looking at that corporate structure would give any regulator, heart palpitations, let alone all the funds moving between that many entities at volume and at speed. And what we've seen, it is just as Anatoly mentioned, it was a preordained mathematical equation that was going to collapse.
Yeah. Okay, thank you. So we have mentioned sort of few times about a failure of sort of lack of the corporate governance, but also, I guess, lack of the sort of interest of the regulators. And I've been reading quite a lot about this, and my understanding is that the firm moved to Bahamas, and Bahamas wanted to position themselves as a sort of country open to cryptocurrencies, and so they sort of put a sort of slightly close eyes on the regulatory aspect of that business. So what do you think? Could regulators do more in this case? Is it the issue of because it hasn't been regulated? Is it a government issue? Anatoly, to you?
Well, I think self-regulation may work on DeFi level, but on CeFi, centralized exchanges, where the system is exposed to the discretionary decisions of a human being, the trust layer and exposure to ethical fabrics of given individual, it wouldn't work. You need really some regulatory oversight. And I think in crypto, unfortunately, we are seeing major crypto business being driven offshore, right? And if you think SBF was an American-born entrepreneur with American degrees, his natural place of business should be US. However, the type of operations FTX was running, i.e. derivatives, are not allowed in the current, in that form in the US. And that led FTX going offshore. Now, I would say because of that, there is a lack of any controls. imposed by the regulation. You cannot really rely on Bohemian, whatever them, local regulators. It's extremely weak, right? As it is in many other parts of the world. So from, I think there was a regulatory failure on a general level of driving business offshore. And as the lesson learned out of that, I would certainly love to see regulatory environment becoming more constructive and accommodating this business onshore, and then creating a framework of control around that. That's going to be a proper client protection.
Okay, Jeff.
Yeah, I mean, just having that framework to work with instead of work against. We've seen exactly the same thing here in the UK. Crypto derivatives banned from every type of investor, even products that were offered by XBT inside of Hargreaves Lansdown SIP pensions. 1-to-1, no leverage. It's an ETP product, but yet it still counts as a derivative. Really wish I'd still had that position, but it's gone now. So having, it doesn't have to be the biggest, craziest, free, open free for all, but even if you could offer a derivative product that was securely backed and properly warehoused, properly custodied, and even if it was like 2-3x maximum, that would still allow UK firms to be competitive in the marketplace. But because of the products we either can't offer or don't want to offer, or whatever the regulation says, it is always going to drive that capital offshore and expose those clients to huge risks. The current approximate count is like 80,000 UK residents that have been exposed to this FTX collapse, not including BlockFi, not including Celsius, and not including the Gemini Genesis lending that's kind of coming out of the woodwork now as well. So if we had a safer way and the ability to offer these products, even if they were on a smaller scale, and having a productive framework, I'm sure the crypto space would be a lot better off by having something rather than nothing.
Mm-hmm. And it's interesting that there often reference is made that it's a very dangerous type of derivative instruments, but that's not what led to client losses.
No.
In FTX case, it was completely different level of failure, and that's
fraud.
what the regulatory oversight was needed.
Yeah. And what was the other thing that came out of Alameda, the hedge fund, is that they had no liquidation controls on any of their trades. So, if you open a position, you open it at 10x, collateral goes to 0, you're wiped out. They had no collateral liquidation requirements. So they could run, a big 300x trade, 3,000% in the red, and never get liquidated using client funds, which is just absolutely A, crazy for business, but B, like you said, I'm glad someone else brought the degen word up in this call. It wasn't just me, because it was pure, just degenerate gamble trading with other people's money.
It's just pure gambling.
If you look at,
go on, Torsten.
If you look at the regulatory landscape for financial products in Europe, or frankly globally, right? I mean, it is, as a UK resident, it's very hard to understand why I can trade on any of the native crypto exchanges and with some sort of leverage, right? So that may become harder as the regulator forms its view there. I cannot trade institutionalized product like an ETP, which actually allows that the coins I invest in are warehoused properly in an institutional grade custody, safeguarded in segregated way, basically similar like you would trade your gold ETP or your S&P 500, etc. Right? Like there's not this institutional product because there's no regulation. There's a lot of people who would love that in the UK. There's a lot of people who are fighting for it in the US.
Yeah.
So for everybody who tries to get access to this new exciting asset class of digital assets of crypto, they are pushed literally by the lack of regulation into areas such as FTX, such as Binance, etc. And that's very dangerous, right? And we have seen time and time again that over-regulation isn't a great thing, and under-regulation isn't either, right? Like, and I've lived in my whole 2+ decades of financial services in a very regulated environment. I know exactly what the cost of that is. It's not cheap, but there's a reason for that, right? Like you're safeguarding people's assets. That's a trust environment you shouldn't breach. And if somebody takes your deposit in, there's a certain way he should treat that deposit, right? And there's therefore a reason, because a lot of people have learned that in traditional finance the hard way, right? Like you do not do that, you will have a lot of systematic risk in the environment, right?
Yeah. Guy, you wanted to add something?
Well, this where it kind of heats up for me, because you know, we're at a sort of a great crossroads here, because we do actually have the technology now to start actually monitoring transactions and wallets and environments and devices. And the problem is human-based regulation hasn't got the ability to react or properly create a balance, because what we're talking about here is a balanced view of how to regulate the ability to speculate within boundaries, right? You don't want to speculate so it goes over the top, because you get these huge crashes and the waves wipe out the whole industry. I'm the CMO of Naivety Protocol, and what we're developing is a system that actually measures blockchains. So it validates validators, and it is able to measure devices in milliseconds and see any alterations in smart contracts in milliseconds. And therefore, you can start to bring proper controls into environments like this, and you can actually go beyond the regulator, because the regulator, let's face it, is always behind the curve. They're always behind, and they're late to the party. And we're actually playing a centralized game on top of amazing decentralized technology. We need to bring it up from beneath the sort of world, the centralized finance transactions we're using, and bring it in there so we can bring proper controls. Would you rather have a scenario where people can speculate and they can make money, but it's within, as Jeff said, you know, it could be the 20 to 30% or something like that. But when you go into 1000x, there's no free lunch. At some point, it's going to hit the rocks. And I think, for me, that's the exciting thing out of this, if there is anything.
Yeah.
Philip.
I mean, I agree. If someone on Twitter can find this in irregularities, then regulators could also do it, probably. I mean, track collaterals, or so those artificially pumped tokens, or focus on companies registered in tax oases. I mean, open company in Switzerland or US or similar and be regulated. But industry is still like really young, and sometimes you can only learn after some bad thing happen like this. We're definitely moving forward, and with every bull market, they always bring something new. So I think that regulators have to give us like clearer regulations and patch these gray areas, and tell us what is allowed and what is forbidden, and what are the consequences, not only for centralized exchanges, but for very other aspects of crypto, maybe including the part of the DeFi, because it's too easy to find a loophole. And now we have Alex Mashinsky or Don Kwan or Sam Bankman. All of them were doing criminal activities, and they stole tens of hundreds or millions of dollars, and they're walking free, drinking cocktails in Bahamas. I mean, I'm not sure, but apparently FTX was under surveillance for some time. So maybe regulators should. But
there's no, I mean, that's the irony. There's no subpoena for him to be arrested. Has anyone got an idea of why that's happening? And he's apparently on Thursday, he's appearing at an event in New York.
How's that possible? I mean, if we did that, we'll get life sentence, and now this is just no problem. I'm okay.
Yeah. So a lot of customers, a lot of people have lost a lot of money, and a lot of fingers are being pointed at the different stakeholders and investors. But that company not only had individual investors, but had actually large companies. So in your view, how can the centralized exchange protect investors, and how the investors can better protect themselves? Philip.
Well, centralized exchanges should maybe lean towards regulation and transparency. And the thing that CZ does now with this proof of reserves maybe seems like a right way to do it, but also that's also something we should maybe take with some kind of reserve, because those are user funds, not theirs. And if users deposit, I don't know, half of the million BTC, we can see that there, but maybe they deposit 1 million. I don't know, because that's just the balance sheet. It's off chain. And also, but I see that exchanges started regulating themselves also. For example, they excluded US citizens from trading. But on the other hand, then look at Binance US of FTX US liquidity. It's uncomparable to non-US exchanges. So centralized exchanges could also, maybe like insure the deposit, but unfortunately the risk is still too high for insurance companies, and fees is too high for everyone. Voyager had something similar, but that was only for fiat, like banks have. And on the other hand, users should focus more on education. They should have funds on centralized exchanges only at the moment of trading. Larger amounts should be held in private wallets, cold ones if possible. And I understand that centralized exchanges UX and UI looks more friendly, and that is majority of people still don't have enough knowledge to use DeFi and access. But I think it's time to finally understand what not your keys, not your coins phrase means, right?
Philip, to correct you here, the logic of Merkle tree proof of reserve is that each account, right, by each individual client is then aggregated in a one large tree, but you as a client, you can go back and check that your balance, whatever is million or $500,000, is properly reflected in the entire tree. However, this would not actually guarantee safety or kind of solvency of underlying exchange.
Yeah, exactly. That's what I thought. Yeah.
Because even if you capture all the accounts properly, you're going to have only one side of the balance sheet. You don't see what happens with this exchange on the other side, how the assets are deployed, what the liability are there. So basically, to draw any conclusion on the solvency of an exchange, you need transparency of both sides of balance sheet.
Exactly. Yeah, that's what I thought.
Proof of reserve is first step, but not sufficient step. Fundamentally, there is a completely different solution to that, is never give your capital to an exchange. Now, it's counterintuitive, because if you need to trade at an exchange, how can you be present without having capital there? And the answer to that is what is called off-exchange settlement. The logic is, and actually it's already, concept exists, it has been introduced a couple of years ago. And a good example would be Copper Clear Loop. So Copper is one of the custodians in this space. They have a concept called Clear Loop. The logic is, for us as a trader, we can have capital permanently held by an independent custodian. And when I have to go to any exchange, instead of taking my 100 million as my margin to say a kind of Coinbase, we can have a tri-party agreement between us, Coinbase, and the custodian, that this 100 million will be earmarked, i.e. allocated in favor of that exchange, but it will not be physically moved to that exchange. It will remain with the custodian. However, if my trade goes badly, exchange have a claim on this capital, which is natural, right? So the way it's designed, any P&L which emerges out of my trades would be settled pretty much real time between us and the exchange. But the capital itself never touches the exchange. The beauty of this system, if exchange goes bust, so be it. We never had the capital there. And if you accept this formula, if all clients are trading at the exchange using this approach, then you don't need proof of reserves, because actually you don't care what happens to the exchange. All they have to do is run matching engine without touching clients' funds, without custodying clients' funds. And that would be a fundamental solution to this problem. As a matter of fact, this concept has been kind of pushed by many players in the market for the last couple of years, but allocation of powers was in favor of exchanges. They were free to say, we don't want to accept that. You don't want to trade? Well, get lost, right? And basically, you just didn't have this ability to enforce them to accept off-exchange settlement. Post-FTX world, I think the era of corporate investors placing capital on given exchanges is pretty much a thing for the past. I think we're going to have a very fast adoption of off-exchange settlement as a prerequisite for large capital ever to trade on certain on any exchanges, right? It's a matter of time, but that's the direction of travel.
Jeff, what are your thoughts?
No, I agree. Yeah, I think what Anatoly said there is I think that's the next, forget next bull run. I think that's the next evolution of, that sort of trading and that sort of custody. I think it'll be maybe not the norm, but it'll be that kind of client-driven demand, either client-driven through a B2B, client-driven through whoever the introducing party is. But retail are going to be the ones that's kind of left behind with that. So they're going to kind of be stuck in that kind of void in the middle of, unless there's a retail offering with a custodian where they can literally deposit their funds, get their check and balances, and then simply say, connect my CoinPass account, connect my Binance account, connect my whatever, and then everyone can be an arbitrage trader, leveraging something like that clear loop system. So it'll come about. It'll take time, but I definitely see that is something that's going to evolve out of maybe just necessity, because if you go on to CoinMarketCap, there's 1,000 different exchanges on there. A lot of them we've never ever heard of, touting millions upon millions of trading volume, which clearly doesn't exist. So it'll be one of those survival of the fittest moments, but I think it's another step to legitimize. So why don't do these in the afternoon? Legitimize our market segment even further.
Okay, Guy.
Yeah, I mean, I agree totally with what Anatoly says and Jeff, but I see there's another two limbs to this. One, exchanges, centralized exchanges, should argue for more regulation, and they should actually be willingly and openly educating regulators on all aspects of how a centralized exchange operates.
That's what SBF did.
yeah, exactly. He wants to bring respectability to centralized exchanges, so that regulators really understand how these things work, and on top of that, which is this is my specialism here. I'm not a specialist in particularly in big investment trading. I do believe, or I'm developing it with Nara's protocol, is that there is an ability to now create real-time, zero knowledge proof monitoring of all aspects of the digital world. So there's no excuse anymore. The question is, have we got the appetite for it? Do we want to be transparent? Some don't, and that's fine, but some do. And the question is, Anatoly's idea and Jeff's idea, and working with regulators and bringing in the type of technology that's coming over the horizon, which is blockchain and AI mainly. There is an opportunity to create a much safer environment where we could build in the type of rewards that are kind of sensible and suitable or whatever. Yeah, over there might be the Wild West, but you don't go there if you're going to lose your share every year.
Yeah, Torsten.
Yeah, I think there's a lot of talk for the need of regulation. I'm the one who's saying mostly also happily in Europe and US, etc. We should have good, clear regulation. But there's another element now that investors realizing how much risk there is actually when you keep your money on exchange. There's no regulator need to come to an exchange and say you need to custody your assets for the clients you have. The exchange could just do that as a matter of a competitive advantage. You could just literally set up an exchange and say well, we're not going to hold anything on exchange. We have the custody of our client assets. We put it in maybe in a third-party custodian even. We charge maybe a little bit for that kind of service, etc. That you could do that already, right? You don't need a regulator to tell you need to do that. Somebody couldn't just do that and see then what happens with flows, right? The reason it hasn't happened is because client assets apparently on some of the centralized exchange were free for lunch, and that clearly is not that clearly went horribly wrong, right?
Yeah.
But that's one model which I would be excited to see, frankly, with or without the regulation. Even if you're in the Bahamas or God knows where, you could still connect to a Copper or Coinbase or whatever else custodian account, and basically anything which is not readily tradable, put in there, right? And then have some sort of service level agreement with your clients. I mean, there needs to be a bit of thought put behind the business model, but that does exist. And the other thing I would say about centralized exchanges is what is very uncommon in crypto, but is very common in the traditional exchange space, is that you have listing requirements. So not every asset in the world which you could potentially list needs to be listed, right? That should be a given, right? Not just because there's somebody who makes you a price or somebody has an asset doesn't mean it needs to be listed on the LSE or on the NASDAQ or on the NYSE. But that in crypto is kind of the more coins you have, the more protocols you have, the more appearance you have apparently for the people who want to trade and potentially punt. And so there's this race of how much coverage can you give to clients who want to come to exchange, deposit funds there and then trade. That needs to be rolled back again. The native business model of an exchange is price discovery, nothing else, right? So when they go back to that, then you go back to like what is actually worthwhile discovering for what token. And when you have listing requirements and barriers of entry to like list something on an exchange, I'm pretty sure an FTT token wouldn't be listed everywhere. In fact, there were certain players who wouldn't touch it, right? There weren't enough of it, clearly, but they are. And you have that kind of like multi-level of like filter mechanism before some retail investor can actually go in and punt on it, right? Like forget the institutional crowd. And I know a lot of people got hurt really badly, but they at least have the tools and the wallet to go out and protect themselves. But if the retail mom and pop go in and trust money on the FTX because they couldn't buy an ETP or some other regulated instrument, so like, okay, go there, then there needs to be some sort of like understanding of like, you just can't give them certain things. I think that again, if I go to a Harvey Lansdowne or any kind of brokerage account, there is a certain process I have to go in before I trade a 3x NASDAQ ETP or like a buy an option, right? And that process again is not because the technology isn't there; it's because human beings are inherently happy to take risks and inherently unhappy when the risk actually materializes, right?
Funny you mentioned that, Torsten. So I've actually got, we've only got about 22 assets on our exchange. And I've actually got the timeline of when we added those groups of tokens. And every time we added a group of tokens, we just sold more Bitcoin and ETH. So we're kind of like, yeah, let's just raise the listing requirements because, supporting the liquidity, the wallet infrastructure, the security, the people, the time, a lot of those tokens still haven't paid themselves off in terms of our time and tech investment. So having 300 tokens looks great and it's a good little marketing bit, but people are essentially looking at stablecoins, Bitcoin, ETH, and staking is what I would kind of say.
Yeah. So what do we think? Do the investors understand that the cryptocurrency exchange must show similar operational resilience to the large banks in the world?
I actually think far beyond what is our large banks are adhering to, because what FTX showed us that fractional reserve system without the luxury of central bank does not work, right? And FTX ran exactly this not fully backed structure. And when they run into liquidity squeeze, there is no lender of last resort to probe them. In the traditional space, all banks run fractional reserve systems, and that's part of their business model. You raise deposits, you on-lend them to generate yield, right? But if you are squeezed on liquidity, there is somebody to help you out. In crypto, there is no other choice but one-to-one at all times, right? And I think from that perspective, sorry.
So what would happen if all customers of a bank went into a bank and asked for their money in cash?
So in a traditional
what would happen?
In a traditional space, you would have a standing credit line by the central bank, and central bank
will have bank run,
right?
Yeah.
No, we will have bank run because only like 8 or 10% of world money is in cash, meaning that 90 or 92 is digital. Banks don't have operational resilience.
Yeah, if you look in the beginning of last century, how the central bank concept emerged through Federal Reserve System, what exactly in response to the bank run of 1907. And that's where you had number of bank collapses because there was no lender of last resort. JP Morgan was the one who pushed forward the concept, and Fed was established in 1913. Now, in crypto, we don't have this luxury. You don't have central bank. And given that we're pushing for the concept of decentralization, there shouldn't be one, right? From that perspective, the only model which works is fully backed reserves. And that's exactly what exchanges are supposed to do, right? Kind of you read terms and conditions. There is no rehypothecation of clients' assets, but it does happen. And that leads to liquidity squeeze, duration mismatch, and collapses.
Jeff, what's your
I mean, in terms of our business, exactly what Anatoly said, we're very boring. We're one-to-one. The balance is on the database, on our financial statements match exactly what's in our storage. As opposed to other people, I quite like sleeping. So rehypothecating any funds outside of our custody just doesn't happen. We get offers all the time to build this lending product, build X, Y, and Z. All of those require customer funds to leave our exchange, so we don't do that kind of business. We are looking at doing staking next year, but they're all DeFi on-chain stuff, nothing black book, nothing internal, no internal risk. And that's kind of the way it should be. I think exchanges can make more than enough money with good operational controls, good quality custody, good security on a one-to-one spot, and don't need to go and do these crazy degen things in order to make additional revenue. I think if you have a good product, a good standing, well-regulated, good banking support, you can have a well-rounded business model that can serve everyone's interests without running into these kind of issues.
Thorsten, what do you think?
Yeah, I mean, if you're an exchange, you call yourself an exchange, you should focus on exchange, right? Like that's, I love what Jeff just said. Like it's just really very clear and transparent, and that's what we do, right? And then you do it really well, and hopefully good things will happen for your business if everything comes together. And if you do other things, then you call yourself other things, and you do those things probably really well, or at least be transparent about it, and then people can make their assessment. So I think I'm having a hard time comparing banks to crypto, because like when we look at the last 15 years, and banks haven't really made a great story, right? And neither does crypto in the last 15, 18 months or whatever it is, right? So the resilience is key rather than the comparison with another industry, I think, right? Wherever you're touching other people's assets, the other people need to understand that you are a credit risk to them, and you need to understand that you have to treat them in a certain way, right? And that certain way can be either enforced by a regulator, can be self-imposed, etc. I think what's really important to understand is crypto actually has those rails, right? We do already have infrastructure in place which allows you to give that resilience, either by being transparent about reserves, by the way you treat the deposits from clients, for example, just do one-on-ones, or by when you want to offer leverage products, at least shield the other assets from other clients who don't want to do that by segregating them, etc. And then there's a lot of other things you can do as an exchange that added values, I'm sure, right? Like again, the resilience comes from a nature of understanding what you need to do and what you should do, and then offering that. And in a lot of ways, you have a lot of products out there in the market which do that already. The mass adoption, unfortunately, came on this really great interface of the centralized exchange, and I'm guilty as much. I have equally my trading started there, right? Because it is very shiny, you feel very flash, and you're like, oh, this looks like a proper trading screen. But you also need to be aware of, like, I don't know what's behind it, right? And when you don't know what's behind it, then you should think about where you're parking your assets. So I think the resilience of the exchanges, no matter if it's centralized crypto, traditional exchanges, or anything else, or a frankly investment product in crypto, the resilience comes from the structure it's built around, right?
But I think that's some of that resilience as well. We're coming out of a market now where or in a market where when it comes to fintech, use of technical products from your Googles, your Facebooks, all the way through to your financial apps, people are very used to not paying for anything. So as soon as there's any sort of hint of barrier to entry or any sort of hint of compliance or cost or any of that kind of stuff, it'll shift people away. People obviously want to make money. They want to make their assets and work for them. And as soon as there's a fee they don't like, or a widget they don't like, or something like that, or it doesn't have a free option, it sends them elsewhere. So the resilience of some of those products, while there's a regulation overhead that you need to maintain, the proof of reserves, custody, operations, all that kind of stuff costs money. Now, exchange is supposed to be profitable as well as offering a service, but it can be a very tricky thing when we're in a market where it's a race to the bottom. It's a very tricky balance.
Yeah, Guy, what's your view?
Yeah, I thought that's very true and correct. What Jeff just said there. There's a mindset in crypto which is very much the adoption, the degen kind of mindset, that everything needs to be for free, and to make the absolute maximum amount of profit right across the board. But as we know, that's just not working right now. And I still believe there is actually very little trust in crypto with the type of controls, if there are any, available. And I do believe, as I said before, I think there's an opportunity now to really create some new landscape where, is there the appetite for an exchange to be able to measure itself with technology, and then show that and show real resilience, because you're able to show a true one-for-one balance, which is then a true exchange. And there's text going on from Jesse Powell from Kraken talking about proof of reserves, and CZ talking about the proof of reserves he's talking about on Bitcoin. But at the end of the day, you still can't trust it because it's not measured by a third party. And that's where it needs to be. It needs to happen. So then people have real trust. And then potentially you could shift that mindset that Jeff's talking about, which must be, you know, he obviously sees that every day being in the position he is, that people want it for free. And if they don't get it for free, they're gone. We go, you know, and they're squabbling over tiny little margins, like literally, you know, a quarter of a percent.
We've seen some of our deals blow up over
it's crazy.
A £1 difference in spread.
Yeah.
Yeah.
Yeah. And it's everywhere. I mean, it's, you know, I've even experienced it myself going, should I go to this exchange? Because it's like, you know, 0.25%. And it is a mindset, and we need to change it, because the outcome generally is we can change this real crazy boom and bust. That is, it's, you know, this is really set, and there's more to come. There is more to come, and you know, it's really set us back. So I think there is an opportunity to practice real resilience, and we should grab it with both hands. And those that do, I think, will win in the long term.
I think market was greatly mispricing the counterparty risk, chasing spreads instead of looking on what risk you are assuming by trading in a whatever given venue. And going forward, that's going to be a much greater topic: counterparty risk and overall transparency of underlying exchange.
I think it's also the exit mechanisms. You can get into an exchange very easily using debit card deposits, whatever it is. A lot of people aren't valuing that exit. How do I get any of my profits back to my bank? And that's something we've excelled at for 4.5 years we've been in this business. We see a lot of inflow. We see way more outflow sometimes, because people just don't have those rails out. The exchanges don't have those really solid banking relationships. They're working with third parties at an arm's reach, and it's kind of not their problem. That's something we've kind of brought closer into our perimeter, which is why we've had, you know, some stickier clients that they need that proper out rail to get back to let's say legacy banking system, existing banking system. Save myself a little bit, but you know what I mean.
So we've sort of talked about, you know, all the current sort of challenges, and really we can sort of compare the current state of the sort of cryptocurrency market to the dot-com bubble burst. So all seems to be sort of gloom and doom at the moment, but in your opinions, what are the lessons learned, and what can we do in the future, and what is the way forward? Philip.
Yeah, I mean, as I mentioned, for investors probably learned that it's not your keys, it's not your coins, and it's not necessary. Don't hold them on your centralized exchanges. I mean, like 10% on stablecoin is unsustainable. BUSD is backed by US Treasury bonds, which gives you like 4.5% max. I mean, I just saw that KuCoin and Binance are giving like 200%, 300%, 400% on stablecoin. That's insane. I mean, no one can give you more than that if they are not gambling with your money. And there is not like good or bad exchange. There's only bad actors. And FTX, I think maybe they had sustainable business. They were earning from fees. Everything else was bad, greedy leaders. And I know that decentralized exchange are still a little bit complicated. We at Genius Yield, we're building a rather simple one, order book based. So it'll be kind of similar to centralized exchange, but with your own funds. And I mean, now we should only focus on building the trust and building the regulation. And we should remember that nothing anymore is too big to fail. And I believe, and this is not the end. And I think that more will fall in this bear market.
Sorry, I was on mute.
You're muted, yeah.
Yes, sorry. Is there hope for the future? Guy, what do you think?
Of course it is.
Yeah, because the future is this. The problem isn't decentralization. The problem is humans playing, you know, games on top of centralization. And this is we're in the, you know, the great change in epoch now, where we've got this opportunity to move into real decentralization. And who's going to be bold enough to really take that on board? And that's what's really exciting me about this. And yeah, I think there's a whole load of dominoes yet to fall out of this. it's going to set us back. But actually, this is the way nature works, right? You know, new opportunities are born out of chaos, and the opportunity I see from, you know, my point of view is that we can't trust humans in these environments and landscapes, and now we've got the speed of technology, we've got the security of maths, we've got the security of cryptography, and we can do some amazing things and still allow people to do what they want to do with exchanges and speculation, and that's never going to stop. But we can definitely bring the boundaries in so it becomes more sustainable. That's what we want, you know. So yeah, I think this is a great opportunity for a few people to be really bold and come out with some excellent products next year and take it to a new level.
If I may add on trust here, the whole blockchain concept is based on the trustless environment. We're not supposed, so you don't have to trust anyone.
Exactly.
Fortunately, the evolution of crypto system had this gravitational pull towards centralized players, being centralized exchanges because of ease of use, easier user interface, and so on. And we became kind of dependent on, again, few centrally controlled entities. And from that perspective, trust again emerged as a necessary element of that. I think one lesson learned from FTX collapse is a mandatory bifurcation of trading engines and custody of clients' assets. Again, as we discussed, the core function of every exchange is running matching engine. Historically, they also have been running clients or kind of custodying client assets. That's how crypto evolved. But it doesn't have to be so. These function has to be segregated, as actually it is in a traditional space. When you trade on New York Stock Exchange, New York Stock Exchange does not hold your asset. They're still held by major custodians, being Bank of America, JP Morgan, BNI Mellon, or State Street, and you just use exchanges matching engine. That's what we should inspire for it in crypto. And essentially, exchanges should focus on their core business, leaving custody as a separate function to another players. And as a trader, I'm very happy to pay custody fees to someone to eliminate counterparty risk with an exchange. Now, the custodian actually becomes another centralized player now, right? Who holds my assets. But this risk is much easier to manage because custodian generally is not involved in anything else but holding assets. There is no other activities per se, while exchanges are involved in so multiple flows that they have more temptation to use clients' assets. And even with a custodian, you don't have to take this counterparty risk. And to give you a preview how it's possible, because we have been running this for the last nearly 4 years, ever since inception of our business. With the custodian, you build a system whereby private key, coming back to not your key, not your asset, your private key, which is supposed to be held by a custodian, you never allow custodian to control that. And the way you do so, you take this private key, which is 64-digit long alphanumerical code, you cryptographically shard it into 3 parts. And then these 3 parts are distributed between custodian, investment manager, and trusted third party. Usually it would be a fund administrator. And then you need these parties to come together in order to merge their part of the keys and execute some complex transaction, like moving asset from point A to point B. And that allows you to control the asset. Custodian itself doesn't have sufficient credentials to abuse your funds. Jointly with you, you have 2 signatures, and this system is based on the 2 out of 3. So in operational environment, investment manager jointly with custodian can move funds. However, if custodian becomes a bad player, it's not a loss of funds, because investment manager jointly with fund administrator, again, 2 out of 3, has sufficient credentials to lift funds from a failed custodian and move to another custodian. And that's fundamentally reduces risk and eliminates what is called single point of failure, because now you have distributed risk. And this is a far more secure structure than having a blind risk on a given exchange, which has full control over your assets, as it was proven with FTX.
Okay, thank you, Anatol. Torsten, what are your sort of key lessons learned and a way forward? Before we move to the...
I'm not excited that this episode happened, but I'm very excited about 2023 and what's coming beyond. I mean, if you look at the infrastructure is fully in place, right? And to the willingness of pay, I think we're talking about highly volatile assets mostly, if we leave the stablecoin part aside, right? So these are highly volatile assets. Give them 80% or 40% volatility. That means per day, they are expected to move 5% or 2.5%. The custody doesn't cost that much, right? Like, we're talking about in a day, you probably go down to your coffee shop, have a coffee and come back to your house. And like that's pretty much what you have to pay for a year worth of custody or something like that, right? So I think the infrastructure is there and people need to now realize there's actually value to it. And the price point of getting that value into their own portfolio isn't very high, right? So it's actually a very efficient way to like do it. So I'm excited about the lens coming on that infrastructure. But more importantly, I think a lot of people in the market who have been what's in a very negative way called tourists or like retail money or whatnot, like people who are exiting in the moment. A lot of people who are not exiting are actually starting to inform themselves much better of what they're trading. So beforehand, if you ask anybody what's a Bitcoin and Ethereum and a Cosmos and then an FTT, I'm not sure if you're getting out of a crowd of 100 people, 50 people who get actually the differences right. I'm pretty sure if you're talking next December, yeah, you will have people who are up in the space, investing in the space. They will know exactly what to invest. It's a bit like in 2001, 2002, when the steel mill put a web page up and had a .com in their name, and all of a sudden they traded at multiples of a tech company. They're still just producing steel, right? And the same as here. Like if you have different tokens, different protocols doing inherently completely different things, they should be valued differently. They should be seen differently, and should attract, frankly, a different volatility and investor profile to them. And that kind of like dispersion of investors to the various sectors they really want to play. And I think hasn't, at least from my perspective, haven't happened that much because the mainstream investor hasn't really understood or didn't really want to engage too much, because crypto ultimately is a small, very exciting part of the portfolio, but the main portfolio typically happens in equity still, right? So if you play a little bit in that exciting part of the portfolio, the marginal, let's say, effort you have to spend to understand the left side of the portfolio and the right side of the portfolio isn't necessarily the best time spent, rather than understanding what your Apple shares and your Peloton shares are or whatever you hold, right? But that will shift, right? And that shift will drive a lot of more adoption, because then we'll find out like, well, maybe there is a killer app in crypto waiting. There's maybe a protocol which is super exciting and people haven't yet really seen it, or maybe it emerges out of all that attention which is coming to the market. So I'm actually really excited about the next year, because all what we've learned in 2022 is there's a lot of like mistakes being repeated in crypto, which really shouldn't have been repeated from traditional finance. Because as we said, the industry is all about not traditional finance, trustlessness, provisionlessness, decentralization, and all of that. What we're seeing right now is exactly the opposite of that, where we basically are in the 1900s of traditional finance at the moment, right? So that will go away, and then there's a very clean slate to build on and like see exciting new protocols and frankly investment opportunities.
Lovely. Thank you very much. So this is now the time we're going to open to the questions from the audience. So let's give it a minute and let's have a look whether we have any questions. So everyone on the line, please feel free to give us any questions. We're just going to wait a minute to see whether any questions are coming up. No. Well, okay, we have a question. Why is CZ so important in all of this?
Well, there is one simple answer. If you look on the volumes, Binance is currently controls well over 50% of global volumes. That gives you a sense of importance. And even it became even worse so now, because essentially Binance has sucked all FTX volumes now, right? It became even larger player. So unfortunately, there is a dependency on one large entity, which is discomforting for many traders, because your counterparty risk, if any, has gone up. And counterparty risk is something which for many traders is the biggest headache, something which keeps us, for example, awake at night. And CZ is a large player.
And don't be so sure that nothing can happen to CZ, to Binance. Just be careful.
Well,
Okay.
this is a given. You should expect everything to happen to every single.
Of course, I mean, if somebody asked me like a month ago who would fail the first, they'll probably some smaller exchanges. And when FTX happened, I mean, that's like the second biggest exchanges in the whole world. You never know what's happening on the backs. You can only see, as Antonio said, you can only see the first the one part of the one part of the balance sheet. You can never see the other part. So that's the problem. Same with all others.
Interesting that I had multiple conversation. We have over 70 investors in our fund, right? And custody or counterparty risk exchanges is a subject to discussion in every single due diligence. Now, every time you talk about an exchange, your fundamental focus is on the external hack, whether their security is sufficient to protect against external loss of capital. But you rarely think about internal hack. And FTX was pretty much kind of inside the job, right?
Yeah.
Everything is inside job. All hacks, it's 99% internal job. How why is never BTC hacked, Bitcoin or Satoshi? Yeah. Because you cannot hack blockchain. You can hack centralized custodians and people who have your money.
Yeah, it's the APIs that are usually at risk, or the front end or a man-in-the-middle attack. It's never a private key, and it's never a blockchain.
Yeah.
We have a few more questions coming up. So the next question is, this is to Philip and Guy. Both Philip and Guy think that there is a further contagious to be revealed beyond DCG and some smaller exchanges which seems priced in. Why?
Well, I'm just keeping my eye on what's happening out there in the news, and it looks as though there's been other lending going on. Well, obviously Genesis are trying to borrow $1 billion, aren't they, right now? I think they're on shaky ground.
Somewhere between 1 and 10. It's a very large spread.
Yeah, exactly.
That's very large.
I mean,
well, it's a percentage. As a percentage, it's not that bad, but as a round number, it's very, very big.
Right.
And then, you know, the news that actually SBF is trying to raise more money to get back into the game is ridiculous. So who knows? I might be completely wrong, but let's face it, the conversation just now about CZ, no one knows what's going on behind the scenes. And that's the problem. No one really knows. And any of them could fall at any time. We don't exactly know what's going on. So, you know, I might be guilty of just following the news trend, but I've got a feeling others are going to go.
Unless you're sitting in the boardroom getting it first-hand knowledge, I don't think there's any way we really can know.
No.
Yeah, because you know, I'm looking at Crypto.com. I'm looking at Nexo, giving those. I mean, Nexo is, what's the difference between Nexo and Celsius? They both giving the ridiculously high. I mean, it's just logic, you know. And when someone said, "Yeah, Crypto.com have like 20% in Shiba," doesn't matter. They're not their funds. They're not their decision. That's traders. That's users' money. They're the one who deposited that. That's nothing to do with its centralized exchange.
Okay, we have another question. We have a few more questions. So next question is, what is the real appetite in the industry to embrace regulations the same way exchange around the world are regulated?
I think, I mean, just starting here, I think the appetite in the industry is super high, because I can tell you, like, there's a lot of people who moved in the industry in the last 12 to 18 months with the excitement of building something and like basically bringing finance to the next generation, right? Like bringing finance to more masses, or like making finance more efficient. There's a lot of great, exciting use cases for the crypto currencies and digital assets. And in the moment, we were talking like right now nearly 1.5 hours about centralized exchanges, contagion risk, etc. That's conversations from the 1980s, maybe, if you want to, right? It's not a conversation for 2022. So there's a lot of like crying out in the moment, please regulate us and allow us, give us rails to operate in. And then at least we can play on a playing field. Like as Jeff says, there's a certain mentality in the moment that everything should be free. So I said earlier, like everything is there. Maybe that would be a competitive advantage if you build something which is more robust. But again, like you need to change the mentality of people. And I don't want to invest in something which is in Bahamas. I'm a European. I'm living in London. I'd like to invest here, right? Because I know the environment. I know what's happening. And if I lose money, it's on me. But I don't want to lose money because there's no safeguards in place, etc. So there's a lot of like push actually from the industry to be regulated. And I think there's a lot of exciting regulatory initiatives. So we're talking MiCA in Europe. That's a great piece of legislation, like really exciting news of legislation. Europe, for all its fragmentation, actually is one of the front runners, giving people the ability to have regulated investment products in crypto if you want to participate in the market. You don't necessarily need to go on a native exchange or decentralized protocol and figure out the tech. Everybody can buy it in the brokerage account in most of the European jurisdictions. The FTA is starting in a lot of different ways with the tokenization efforts, etc. And like again, the SEC CFTC discussion that will just have to, frankly, be sorted out in 2023 because it's not very healthy for the average American investor to have to invest south of the border, right? I mean, we know that's not something which typically is very well regarded in Washington. So I think there's a lot of like excitement for regulation in the industry.
Okay. Thank you. Sorry, we have another question, and this is we're going back to sort of the point we were making earlier about why is SBF not arrested and he's going to New York with Janet Yellen. So why do you guys think that has not happened, and what is the right course of action?
No one knows.
What's the reason why he hasn't been arrested? Well,
Yes,
he's been protected. He's given a huge amount of money to various different parties. He's, his exact location can't always be confirmed, but yet he has the time to do a paid event in New York. So, I don't think it's a good move for him to step onto American soil. He probably won't leave American soil afterwards. I mean, stay in the Bahamas where it's nice and safe and warm. I don't know why he's not in jail, because he's
when no one else is.
Short of admitting, I did it, I ripped everyone off. He's in the crosshairs, so I have no idea why he's not in jail.
I think it comes down to like how much fraud can actually be attached to the personality versus corporate failure, right? Like none of the CEOs from Wall Street banks, and I've worked in Wall Street banks left, right, and center, none of those CEOs went to jail. And the management of a company versus the company doing something bad, the manager should be responsible, and there's new regulation on like how the senior manager regime will actually attach personal responsibility to a manager, but that doesn't exist everywhere. And like again, it just
look at 3 Arrows Capital,
put somebody into jail, right? I'm not saying you shouldn't be. I'm just saying it's not that easy. Your company went on, when a lot of people lost their shirt. That's very tragic, but like unfortunately, there's a difference between that's being tragic and somebody has done something provable unlawful. And
it's probably down to that, If anything, I think there's probably more hate going in the market calling for that stuff than what can be, actually brought into court and legally admissible. So it's a tough one.
Yeah, we have a question for you, Anatoly. The question is, how can we implement your concept to have nodes if one has to consider financial inclusion clearly without any risks?
Didn't get entirely this question. How do we implement the concept of having nodes? Well, which concept are we referring to?
You mean clear loop with copper?
Well, I think clear loop with copper, first of all, is designed for corporate clients, but fundamentally there is no structural reason why retail investors can use the same concept, right? Whereby the principle is it has to be segregated matching engine from custody. And for have-nots, there might be cost involved in that. And by the way, custody does cost money. It's over time will gravitate towards zero. At this stage, the cost of that between 15 and 50 bips. Again, on a scale of things, given that you are reducing counterparty risk, it's worth paying, even if you are a retail client, paying 50 bips when your bet is making whatever 50% is pretty adequate cost, right?
Yeah.
Reducing counterparty risk. So from that perspective, there's no real segregation between people who have money or who do not have money. I wouldn't really go along this line. This concept is open for everyone. The problem was that investors, exchanges used to push this back. And actually in FTX cases, they formally announced that they would join Clearloop back in June 2021, I guess for marketing purposes, because they never implemented it. And now we know why, because they needed actually clients' capital at their premises rather than at a third-party custodian, and then they cannot really use these funds in any other way than
apart from settlement.
Yeah, I actually wanted to add to the previous question on regulation. I think there is certainly drive and demand for regulation from institutional clients, and we can see this in our day-to-day conversations, because from their perspective, if regulation is around, it allows them to engage in much wider range of activities in crypto. Many institutional investors are staying away from DeFi, for example, because it's not properly defined in the regulatory framework, and engaging may fire back, and that holds their complete involvement in this space. So from my perspective, in regulation is good for the sector generally. There are two types of regulations. One is what I call irrationally restrictive and hostile regulation, which usually drives business away from offshore to from onshore to offshore. And another type of regulation, which is more constructive, right, which is designed to allow innovation whilst protecting underlying clients. And that's what global regulation should be inspired by, right, and looking for. And I think that we cannot avoid but having a much stricter regulation around crypto. I would hope it's going to go this constructive avenue rather than just outright prohibiting any involvement of retail or corporate clients.
And just to add, it drives adoption. It will drive adoption, and that's what we want, because it's a great technology. It's a cryptography. It's mathematics. It's secure. It makes sense. And the irony is balanced regulation drives adoption from institutional to retail, and that's what we want. So that makes complete sense.
Okay, thank you. We have a last question before we have to close. So there's a question about sort of the current sort of biggest cryptocurrency exchange, Bianas. Sorry, I'm not pronouncing it correctly.
That's the French version. Bianas.
Yes.
Yeah.
So the question is about the competitors. Is there going to be anyone that can potentially dethrone them? And is there any possibility because it kills competitors?
I think definitely, yeah. It depends what kind of market you trade in. I think there are a lot of people that won't trade on Binance because they, in the past, I'm not sure the exact strategy now. I've played a lot of regulatory arbitrage. They don't have an office anywhere. You can't, no regulator can contact them apart from on Twitter. That's a real problem for not just retail users, but for a lot of corporate institutions. They want to deal with someone local that has a local oversight, that has regulatory approval, that has a proper compliance team, that has a phone number on their website. They want to yell at an account manager, whatever your reasons are. I think we'll start to see a fragmentation in the crypto space for local jurisdictions, maybe. But I think it's down to those clients wanting to pay a couple of extra basis points for those kind of protections. And it's going to take the right client base jiving with the right type of offering for that to happen. Because not everyone wants to be in a big, crazy, massive, globalized business. They want something that's accessible and local, that suits their needs. So I think as the market gets bigger and more developed, I think we'll see natural players rise, but I think you'll see more local counterparties excelling at their local areas.
Philip,
I mean, I just so don't see the future with this kind of centralized exchanges, any of them, because crypto is here, to give you freedom, not to so you can use it for weapons trading or something like that, so for some illegal stuff, but to be decentralized, to each of us can be our own banks, to have our own tokens, to run a nodes so we can, or mine, so we can, be decentralized and defend to lower the costs of everything, to not need to have centralized things like banks or centralized exchanges. And yeah, I mean, I don't know who can take Binance down or if anyone will. And I just don't think there's in the future place for any of those centralized things.
Well, I think transition to decentralized world will take time. This is the
of course
goal, and we should move there. Realistically, centralized exchange are not going anywhere in any time soon. And
no problem.
JP Morgan actually confirms that's their standpoint. Now, I think who can dethrone Binance is really a player who would make an effort to adhere to transparency beyond what is the current norm, right? Essentially, you want a proof of reserves? Here you go. You want a proof of liabilities? Of course. You want a consolidated proof of solvency? We're all for it, right? Kind of, and it's done not on the annual basis or on a monthly basis, but potentially technology allows you to run these proofs on a daily basis. You can do it pretty much real time. And if that is done, that becomes completely different game plan because you are reducing counterparty risk dramatically. And another thing is, as we discussed, this segregation of exchange settlement. Exchanges who would embrace that would say, like, listen, we can either custody your asset, Mr. Client, if this is convenient for you, or if you demand off-exchange settlement, being it Clearloop or any other solution, we're happy to integrate to give you peace of mind. And I think that sort of exchange has the possibility to overtake current leader. Another thing which is critical, it has to be a derivative exchange. Spot exchange has no chances because similar to traditional space, when derivative market is a multiple times of spot market, crypto evolves exactly along the same line. Derivative volumes are much higher than spot. If you are pure spot exchange, you will never become the largest in the world. You have to be a derivative exchange. Unfortunately, as of today, there are restrictions around the world, including in the UK, in the US, and that makes the only biggest player, those who are run derivative operations outside major jurisdictions.
I think, and just the last point on from my side, maybe like, other than Walt Disney, I don't think there's any company I would give it 100-year dominance on anything, right? Like look, in the 90s, we will always hold a Nokia phone in our hands, and maybe if you're really like Rook, you're going to do a Sony Ericsson, and like no one had Apple on the cards because in the 90s, Apple was fighting for survival. Look at that now, right? Nobody knows a Nokia anymore. Then you have BlackBerry and Research in Motion, and there's a million corporate history is full of those examples where somebody had a complete dominance.
Blockbuster.
AOL owned the internet, right?
And failed to evolve.
Mm-hmm. Yeah, exactly. It's always the same story. So I wouldn't be scared to engage in digital assets just because there's Binance and maybe I don't like Binance, or maybe I like Binance and engage, but I don't know. That should be two separate like streams of thoughts. And I completely agree with Anatoly. There's so many degrees of innovation which can come on a centralized exchange. And as to Philip's point, ultimately, hopefully moving into a more decentralized, like trustless environment. That, yeah, Binance may be broken or not. I don't think that's the conversation that actually does matter, right? Like the real conversation is about like the features and what we actually need it for and what do we use it for in the future. And that will drive whoever is droning it. And then we may not care who's sitting there. No one cares to know that Google sits on the internet, right? No one.
Yeah, I mean,
frankly, we don't need to.
As Anthony says, it'll be a long transition, but this is only 10 years old industry.
Exactly, yeah. That was the point I was coming back to. If we're having these kind of conversations now and we're in year 10 or 12.
Yeah, we don't have anything yet.
We don't have anything yet. We're still at layer 1. I mean, the internet is 7 layers deep. We can't even imagine what a layer 7 blockchain even looks like. So
also, centralized exchanges are like entry points for retail people. First, they won't go install wallet and trade on DEXs. They'll go to centralized exchange because it's easy. And because you have the UI is great and UX is fast.
All right, gentlemen. This is sort of the time come to a close. If any of the audience participants have any more questions, please do point those questions to IOD. There's email on the website, and think about those questions, and we will be able to answer them. We will ask the speakers here to answer your questions. So take your time. Don't hesitate. So I guess the summary of today's webinar is that there is still hope. The lessons that to be learned. This is still very new technology, and there's a way forward. I would like to take this opportunity to thank all of the speakers. Thank you very much for your time today, your input and your expertise. I would like to also thank all the participants that have joined us and took the time. And if any of you would like to find out a little bit more about the Institute Directors, please don't hesitate to contact us. Also, the IOD Finance and FinTech Group is always looking for new joiners, new followers. We do have a LinkedIn page. If you have any questions to me about more details about what we do, please don't hesitate to contact me. You can find me on LinkedIn, and I will be happy to have a chat with you. And on this note, once again, I want to thank you very much. And for those who are going to watch football, please enjoy, have fun, and I look forward to hear from you all very soon. Thank you very much, and goodbye.
Thank you.
Cheers.
Bye-bye.
Bye now.
Thank you. Bye bye.